Can you just tell me a little bit about what you're seeing in the high yield market in Europe at the moment?
Yeah, I think as we just discussed on that panel, the interesting thing is that there is substantial liquidity in the market from the institutional investors. You see a mix of structural features that are popping up in the market, portability, you see floating rate notes coming into the market with shorter, obviously, call dates that are being accepted by the investors. And I think what we just discussed on the panel where the investors were participating is that they have that liquidity available, they will accept the terms, and as I just explained today, we were in the market with a former LBO transaction from Pro7 Sat1, and I think that's a crossover type of credit, printed at swaps plus 140 basis points. You see Greece in the market today with a 3 billion reappearance in the market. It's obviously highly, let's say, high demand for the sovereign business. We've seen the wind transaction that we discussed, and I think that is all testimonies of how strong the market is at this moment, and we're taking on the ING side our fair share of running these deals in the market and participating and following up also on the secondary market, trading that business. So I think it is a vibrant market. It's a developing market with these low rates environments. I think it's very interesting also for the corporate market, but also, as we discussed, there's been very few issuers from the Benelux, and we hope that at some stage the high yield bond product will be more used by the Benelux investors, because there has been a handful of deals in the last 2 years.
So are you finding at the moment that this excess liquidity that we're seeing in the market, this excess demand from investors, is allowing banks to get more creative when it comes to the terms or the documentation, portability, covenants?
Yes, for sure. Both on the, let's say, sponsored type of structured acquisition finance business, we see that we on the ING side are also willing to take a closer look at some of the features on the loan side and as well on the high yield bond side. The bridges, the dividend recaps, we're thinking that these are acceptable terms, and I mean, where we would 2, 3, 4 years ago think about 3.5 times leverage would be acceptable and the going concern, we've moved into a 4.5 times easily, and CCC paper is ready and accepted. You see that with the oversubscription of the order books on the wind transaction, and we obviously have the Numericable Altice transaction that is being worked on in the market. So I think those are testimonies of credit, but appetite, and that will remain the same in these low rates environment. The hunt for yield is there either to go long investment grade, so beyond 10, 12, and possibly 15-year transactions, to go into subordinated debt, the hybrid investment grade market, where you will have the instrument predominantly 2 notches downgraded from the corporate rating, and you will see the eagerness to invest in the high yield market as has also almost doubled in Europe versus last year.
So are you seeing that investors prefer a lower credit, as in lower credit quality, and higher yield?
They accept the terms and the rating as it is. I wouldn't say they prefer it, but they accept the terms because as there is a paradigm shift taking place in Europe where lending is, let's say, lesser coming from the financial sector, from the bank sector, and moving into, let's say, the institutional side, where institutional investors historically have put their money at work at lending to the banks. That liquidity on the redemptions comes towards them, and they will have to reinvest that liquidity, and they're looking for the yield, and hence they will accept those terms and accept those ratings, yes.
And if you can look in your crystal ball, what are your predictions?
First of all, from a predictions perspective, I think, contrary to some of the very positive sound bites that I heard today on the European, let's say, economy slightly picking up, I think it's picking up. I'm not yet convinced that we're out of the woods. Hence, I still see unemployment rates, for example, in the youth in Spain, very substantial. I see, let's say, debt to GDP in Italy being concerned, the labour market reforms in France being concerned, the Dutch mortgage market is a concern. So we have some severe concerns across Europe. I think that is, from a macro perspective, keeping the rates very, very low. On the other hand, as I indicated, liquidity is there with the institutional investors, so it remains to be an issue at market. So the debate will be whether the Benelux corporates or the corporates across Europe have the opportunity to use the bond market more actively. And on top of that, I think what we discussed on the panel is also, will smaller deals be more accepted? That means lesser liquidity, maybe a slightly increased premium on the spread side, but I think looking at my crystal ball, we will remain in a very vibrant market with a lot of liquidity for the next 12 to 18 months, where yields will remain low, and only, let's say, a real macro event like a real war in the Ukraine. Currently, the Ukrainian crisis has not impacted the market substantially, with the exception from, let's say, those issuers coming from that specific region. But I think it has not impacted the overall market. So we need a real event to disrupt the market, because the technical liquidity is still out there in the market.
Great. Thank you very much.
You're welcome.